What if you could buy the stocks you love at up to a 50% discount? This isn't a gimmick, it's a professional option strategy that savvy traders use every day to control great names for far less capital. In this video, we'll show you exactly how it works and walk you through real examples of how you can apply it with your own trading account. I'm Mike Bellafiore, co-founder of SME Capital, one of the top proprietary trading firms in the world with traders who earn 7 and even 8 figures per year. If you're serious about learning how pro traders use options to gain an edge, you're in the right place. Let's get to it.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And after hitting its all-time highs in mid-February, the market on an intraday basis in early April very briefly crossed into bear market territory and then bounced, regaining about half of what it lost off of its mid-February highs. And so there are traders who may believe that this whole tariff situation will sort itself out eventually, after which the market will regain its footing and climb back up to all-time highs. And therefore, this year's sell-off may be seen as a buying opportunity. And so the purpose of this video is to teach you the best way to take advantage of circumstances like this, not by going out and flat out buying shares of oversold stocks. You could do that, but you may not be able to afford doing that. But rather, you can use call options to massively reduce the cost of being able to take advantage of oversold conditions at a fraction of the cost of buying the shares. Now, before we get into the options trading strategy that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the options strategy that we're going to be sharing with you in this video. Then, when you're finished, you can come back and watch the rest of this video. One of the ways that traders like to determine if stocks are oversold or not is through the use of the RSI indicator, the Relative Strength Index, which is one of those popular momentum indicators used by day and swing traders. And it's displayed in the form of what is known as an oscillator, which fluctuates between two conditions, oversold and overbought. Generally speaking, when the RSI reading is above 70, that's known as an overbought condition and indicates that the stock has been driven up too high and is likely ready to sell off in the near future. And conversely, a reading of under 30 indicates what are called oversold conditions and are indicative of the likely rally in the near future. Let's take a look at the RSI using the weekly chart for Tesla over the last 3 years. And as you can see, Tesla, for the first time in 3 years on the weekly chart, crossed over into oversold conditions, closing below 30 on the week ending December 23rd. And so let's say right around the close on December 23rd, with Tesla trading at 123.15, suppose that we had pulled up an options chain of Tesla expiring almost exactly a year later on December 15th and searched for the call option that was priced about half the stock price, which in this case is that 75 call priced at 61.13. As you can see, a little less than 50% of the price of the shares themselves, which are trading at 123.15. And so we'll go ahead and buy that 75 call with the strike price that is way below the price of the stock itself. So it's known as a deep in the money call. And so just by way of comparison, buying 100 shares of Tesla would cost $12,315, whereas buying that 75 call option priced at $61.13 would cost less than half of that, an investment of $6,113. And that's because each 75 call option represents the right to buy 100 shares of Tesla at 75 at any time before it expires. So the price is multiplied by 100 to arrive at the cash outlay for the call. And so if we move to the day this option expires on December 15, 2023, a year later, you'll see that Tesla did indeed bounce, closing at $253.50, more than double the price the stock was at when we entered the trade. And so if we had bought the 100 shares, our profit would have been $13,035, which would have been a return of more than 105% in a year, which is obviously great. Now, on the other hand, if we look at the 75 call, well, that one closed with the price of $178.10, almost exactly the difference between Tesla's closing price and the 75 calls strike price, which makes sense, right? Because Obviously, the right to buy Tesla for a price of 75 when the stock is trading at 250, 350, the value of that right should be approximately the discount you're getting for having the right to buy those shares so much cheaper than they're trading in the open market. And so if you do the math, that price of 178.10 is almost exactly that discount. And so if we now calculate the profit on this trade, you can see that while the absolute dollar profit was slightly less than owning the shares at $11,697, the capital outlay was less than half. And so the return is naturally going to be much higher at a fantastic 191%. And the underlying reason for this massive contrast in returns is the fact that deep in the money calls provide you with essentially leverage so that you can have a dollar return very close to what you could have made with double the investment. But the percentage return isn't even close. The deep in the money calls will blow the returns on the shares away in almost all cases, provided the stock, of course, rallies sufficiently for these stellar returns to emerge. And so that you'll see that this is no fluke, let's take a look at another example. And so in this case, let's take a look at Caterpillar, again using the weekly chart. As you can see, at the beginning of COVID-19, in March of 2020, when most stocks were crashing given the uncertainty of how the pandemic was going to play out, CAT and many other stocks fell into oversold conditions during the week ending March 13th, with the RSI dropping below 30. And so with the stock closing at 99.64 on March 13th, we find a deep in the money call expiring a year later on March 19th, again trading at a price less than half of the stock's price, which in this case is the 55 call trading for $46. And we buy that one. Buying the shares would have cost $99.64, but the deep in the money call outlay is only $4,600, less than half. And so if we now move to the expiration date of this CAT option a year later on March 19, 2021, we can see that the stock had rallied to $225.29 that day, more than doubling from its lows in March when the RSI had fallen below 30. And so the profit on our shares comes out to $12,565, a return of 126%. Turning to the call, it again expired, as it always will, at a price equal to almost exactly the discount you'd receive if you exercised the call and bought the shares for $55. And that's because that's approximately the exact value of that right in this case, with the stock closing on expiration day at a price of $225.29. And so turning to the results of this trade, the dollar profit on the call is only a few dollars less than the share profit, $12,480. But the returns are a whopping 271%. And that, again, is because the initial capital outlay was so much less. And so, again, we see the disproportionate effect that buying deep in the money calls has on the returns of a successful bullish trade on a stock, with returns in this case more than double the returns of outright buying the shares. There's another way of looking at all this. In both of these case studies, we bought the call that was about half the price of the shares, right? So for basically the same amount of capital as buying the shares, we could have bought two of those call options. So let's take a look at how that plays out. And so in the case of the Tesla shares, that $12,315 investment, as we mentioned, yielded $13,035, whereas buying two calls for slightly less capital yields over $23,000 in profit. And in the case of Caterpillar, the shares, as before, had a $12,565 profit, whereas in the case of the two calls, the profits were very nearly double, for again, slightly less capital, making a profit of $24,960. And so what I'd like you to take away from today's video is that there's an alternative to outright buying shares of stock, and that is the use of deep in the money calls to act as basically a stock surrogate. With deep in the money calls, you get most of the benefits of owning the shares in the case of a rally, but for a huge discount off the price of the actual equity shares. As you can see, there are some cases where the results are flat out astounding compared to owning the shares. And so it's a compelling idea to consider. Professional options traders use deep in the money calls on stocks that they love all the time, and now you understand why.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.